Tanvee Gupta Jain joining us now. She's Chief India Economist at UBS Securities. Jaideep Iyer, Head of Strategy at RBI Bank with us, as is Katrina L, Director Economic Research at Moody's Analytics. Welcome to all of you and thank you so much. Tanvee, on a scale of 1 to 10, surprise at what the governor has said?
I would say I'm definitely surprised. We never had a 50 basis point rate cut, 25. We were not expecting a CRR rate cut, especially when liquidity is so much in surplus. I didn't realize that the RBI will go ahead and do a CRR, which means they were uncertain whether this liquidity can sustain or not. And clearly the stance changed. So I think in a scale of 1 to 10, I would say 8.
Wow, so 8 and a positive 8 that I can see there. The messaging seems to be very clear. Katrina, let me come to you on that. The messaging is very clear that growth, and we will go whole hog behind growth. There's no holding back here.
I think that makes a lot of sense to deliver this additional 50 basis points, because if we're looking now at the actual settings of monetary policy, we can see that now the policy rate is in neutral. So it's no longer being restrictive of domestic demand, and which makes sense at this point, given the significant downside risks to global growth and the vulnerabilities that India's economy has. So I think that 50 basis points to rush a bit quicker to get there, was the appropriate move at this point, even though it has been a bit of a surprise to markets.
Right. Thanks, Katrina. Jaideep, let me come to you as well. Taking into consideration, what they've said in terms of the stance as well, are they being overly cautious to avoid overstimulation? Or by keeping it neutral, is it more flexible to either maintain or adjust them depending on the incoming data they see from the global markets as well? Jaideep.
Okay, sorry, I didn't realize that was for me. I think, from a banker standpoint, I think we've in the past generally expected stance to go with liquidity. And when the governor announced change of stance from accommodative to neutral, I was a little, disappointed to say the least. But I think the CRR bazooka came in after that. So I think the way I would interpret it is that the neutral stand is just to say that more rate cuts are obviously subject to data, subject to growth, inflation dynamics, and so on and so forth. But there is no need to worry on liquidity. Liquidity is going to be easy, and a liquidity through CRR cut by far is one durable, definitely, and also is a direct impact to banks' profitability. So all of that would mean more confidence from the banking sector to lower rates on the lending side. Which is what I think is being attempted here. So, I think my answer on a scale of 1 to 10 is a surprise on 10. All parameters. Whether it is rate cut, whether it is stance, whether it is CRR cut, I think it was quite amazing.
No, and before I go to Jayesh, I was going to ask Tanvee. Tanvee, why is Tanvee at 8? I mean, what would have made it 10? Was she wanting the stance to not change? But that was the key. Yeah, sorry,
no, I think 8 is a very good number, I won't say, but a part of it was expected. There was a section of market who was expecting a 50 basis point rate cut. Yeah. People thought, looking at the bank credit growth number for the month of April, at least we have the mid-April number, the credit growth was 9.8, growing in line with nominal GDP. And so we definitely wanted credit to come back to get some boost on leverage funded consumption, to give some boost on the investment cycle. So I think I won't say it was a complete surprise, because there was a big section, small section which was still saying a 50 basis point rate cut.
Okay, so no surprise, and which is why an 8, but maybe could have been a 10. Jayesh Mehta is with us as well. Jayesh, what is your first reaction? Because there are 2 or 3 things out here, right? I mean, the repo, the CRR in 4 tranches, the government. I mean, do you think the governor is saying that liquidity will stay ample? Or is the governor saying that, hey, we are not sure about the liquidity and therefore we are enacting those CRR cuts? And of course, the change of stance as well. How do you think about that?
The 2 things, the expectation was, now and the next policy, one would not look at beyond that. So, but if you look at next 4 months, the trajectory was perfectly fine. So why not do it now rather than doing 25 now and then in 2 months later? So I think that was a good surprise, though there was 20% people expecting that could be 50 basis point, and I think they acted upon it. So I think there is a decisive action to support growth, and doing it upfront anyway made sense, because if you are thinking that you want to do it now and 2 months later, might as well do it upfront, right? So that's one part of it. And second part of it is like the CRR. Again, if you really look at it, right, it's actually starting from September. So it is actually assuring you, for if there is some other things which happens, liquidity will be provided, and that liquidity will be there because we'll have the busy season starting from the second half, right? And from that perspective, you will also have festivity seasons and stuff like that. So the liquidity will be enough at that point of time. And the idea is, of course, there is also one more thing on liquidity, which is being there. It's not only pure liquidity, but it's also a change of stance on reserves, not only us, but every global central bank right now. US exceptionalism is kind of dying out, and therefore why do you increase your allocation more to US? And there is no other alternative at this juncture, might as well support the local balance sheet. So it's like either you increase your foreign currency exposure or you increase your INR exposure on the balance sheet. And same for every global bank in the world. Global central bank in the world. So I think it's very good, very supportive, very upfront thing is always good. I would not worry too much on the stance because you still have visibility of next 4 months. You don't have visibility beyond that.
Yes.
Maybe next policy where we will see the stance could, depending on the data.
Okay, so before I come to all of you on what you think the quantum of cuts in this calendar is going to be, I want to bring in Pranav Gundlapalle, Senior Research Analyst at Bernstein, also joining in on the conversation. Pranav, so glad to have you on. Should I ask you the surprise question? Everyone is talking about how surprised they were. Was it a gasp? Was it a wow when you heard 50 basis point and then add that on with 100 basis point in a CRR cut? What is the very clear messaging from the governor and what does it mean for financials?
I think at least from a financials perspective, it's almost a relief because the loan growth had started to drop. It dropped from 16 percentage points a year ago to 10. So I think both the actions, the CRR cut as well as the larger than expected rate cut, is a way of saying that we need loan growth today and we don't want to wait for 6 months or 12 months before the new LCR guidelines or anything else kicks in. So I think it's a statement that there is urgency to bring back credit growth, which is now dropped to sub 10%. So it is good for the banking sector, and the assurance of liquidity will hopefully let the lenders lend a bit more aggressively.
Yeah, well, Jaideep Iyer, will lenders lend more aggressively? As a banker, you said it's glass half full, glass half empty. How do you think lenders will lend more aggressively?
No, I think I guess if you look at the CRR cut, I think that's a big boost to profitability. I mean, my rough math is that the system will benefit to the extent of 15 to 17,000 crores, if not more, in terms of less cost or more profit, or whichever way you look at it. And I think that's a big thing. I don't think anybody ever expected CRR cut. And I think while the stance is neutral, which is a bit of a surprise, but I guess I would still clearly interpret that this is a message that we need more credit growth. And with rates coming down, the good part from a system standpoint is that this is the first cycle, downward cycle with EBLR regulations in place. So by definition, the transmission on the lending side is going to be reasonably quick. And I think we'll have to see how deposit growth pans out and how quickly banks are able to cut deposit rates, because that will be a consequence naturally out of this policy. But on a net basis, I would expect credit growth to clearly pick up.
Okay. Now, the question, Katrina, the belief that some people might also have that if the Fed is supportive, right, and because inflation in India is going to be low, despite the change in stance, there might be a possibility of some expectations of a rate cut too. Now, is the Fed decision going to be the driving factor for further rate cuts from emerging market central banks like India?
I mean, I think it will remain certainly an input, but it won't necessarily remain a key underlying driver. And I think if we take a step back and look at why central banks in emerging markets, including the Reserve Bank of India, have been able to cut quite aggressively, including today's 50 basis point cut, it's because we have had that sustained dollar weakness for the best part of this year. And so because of that, currencies like the rupee have been fairly steady, even though they are weak by historical standards. So it has given central banks that flexibility to provide that additional support to domestic demand, particularly private consumption, particularly to lift credit growth. So I think as long as the dollar does stay relatively soft, and our expectations are that it will, then that should keep the door open for central banks to provide that additional support should they need that. But at this stage, our baseline forecast doesn't incorporate further rate cuts from the RBI because we do think that they are now at that neutral level, and so they don't necessarily need to, at this point, deliver further cuts to make this stance more expansionary for domestic demand at this point.
Katrina. Right. In fact, thanks, Katrina. That's an interesting take as well. Thank you, Jaideep, as well for joining in. Let me come to Tanvee. Tanvee, we're talking about in terms of the interest rate direction as well from here on. So do you think the stance is more towards that and not liquidity management? How would you read into it?
Okay. So I would say the stance is basically giving some buffer to the RBI because the global uncertainty continues to remain elevated. So in case you need to respond at some point, you still have some 25 to 50 basis point buffer. You need to see that even if I look at 1 year forward inflation forecast by RBI, which is 3.7%, and RBI in the annual report mentioned that 1.4 to 1.9 is their neutral rate, which basically means your headline repo rate should be somewhere between 5.1 and 5.6. It is right now 5.5, which basically is telling you that they have some ammunition in hand. And neutral basically means depending upon which direction the macro is shaping up, we can swing. So even though I think we are done for the rate cut cycle for now, but I would still say 25 to 50 basis point is still the buffer the RBI has kept in its hand in case the growth surprises on the downside.
Yeah, that's an important point. Okay. Tanvee, we'll let you go on that note. Thanks so much for joining in. Now, we took the initial view from Jayesh, Mehta, and all of our guests, Pranav as well. Jayesh, I want to come to you on a specific piece. What happens to, let's say, for example, the rate sensitives? What happens to bond markets? What happens to currency over the course of the next 3 months as the RBI is showing its hand that yes, they will take actions, but maybe not on the benchmark repo rate?
So of course, I think even on the stance, first let me say that, I think I look forward for the stance on the policy 2 months later. That's very important because right now, you had 4-month visibility and you actually did it upfront rather than doing 25. So that stance, whether at that point of time, whether your 3.7 remains 3.7 or lower, I think that's going to be very, very crucial on the inflation projection, right? If that does not change, then we can expect another 25 basis point rate cut. As far as markets concerned, at this moment, normal traders would typically say go for profit booking, and now that the stance is neutral, and therefore not really expecting further rate cut. But let's look at it, right? It's not only neutral, it's 5.5 is reality, and then you also have ample liquidity, which will continue. So maybe after the initial round of a little bit of profit booking, we will see the yields going down. Definitely, at 5.5 repo rate, there is no logical reason for long bond, 10-year bond to be above 6%, right? And that has to move. And that will take some time, but eventually it will seep in. So that's there on the rate side, definitely it will come down. I think on the currency side, very clearly 2 things, actually 3 things. One is, of course, dollar weakness. This is the global thing. In spite of that, we are seeing some moment of upward coming in because people do believe that there is some forward sales by RBI which they will cover. I might have a different view than the market there that, we have enough reserves. We don't need to really cover that unless they get their own pricing. And we don't know that pricing. Could it be 84? Could it be 83? We don't know that pricing where they would want to cover that. Or maybe they don't want to cover it, right? As I said earlier, it could be, why keep on building foreign currency balance sheet, rather build a local currency balance sheet and support the local growth. So maybe that thinking needs to be, seen that whether it is moving towards that direction. But yes, a lot of central banks are thinking on that lines, right? So
Probably
from that
that's what
perspective,
RBI is also looking at, Jayesh. But let me also get in Pranav into the conversation, and we have Aditi Nair also joining in. Aditi, I'll come back to you. But Pranav, taking into consideration now, the question is going to be with regards to how effective the transmission is going to be and the impact that the banks will see in terms of their financials. What's the view that you're picking up in terms of FY26? How will that entire cycle work according to you?
Right. So I think with the rate cuts and the promise of abundant liquidity, two things will happen. One, we expect growth to improve. I think especially with the CRR cut thrown in, from the current 10% system growth, we expect banking credit to get back to 12-13%. So I think that's the first positive. So we could see a bit of a growth surprise on the positive side for the banks. On the margins, given the abundant liquidity, we again expect a positive surprise on the margins, because steady state rate cut should not damage the margins too much for the banks. It's only the transmission delays which will damage the margins, again, temporarily. Here, with liquidity being abundant, I think banks will be aggressive in cutting the deposit rates, which means by end of FY26, the net impact on net interest margins might not be as bad as feared. So we're talking about 15 to 20 basis points impact to NIM for the full year in the worst case scenario. So overall, a positive surprise versus what is right now penciled in by the estimates, and therefore positive in the banks. For the NBFCs, yes, again, the rate cut is always a positive. I think the two things which become a drag is, one, what is already penciled in terms of expectations. I think a fairly sharp growth is already expected from these lenders. And second, with rate cuts being brought forward, it's also seen as an indication that growth needs support. And in case it doesn't come back strongly, then there'll be a bigger negative surprise for the NBFCs than banks. So throwing valuations, impact on the metrics, probably side with the banks at this stage. They offer a better risk-reward trade-off compared to the NBFCs at this stage, especially the large private sector banks.
Pranav, very quickly, is that a minority view? A lot of people are saying that the cost of funds coming down might actually be positive more for NBFCs. So are you a minority? Are you a contrarian here?
Yes, because we do see the growth risk. I think you will not get both. You will not get growth and margin benefit. If RBI has been aggressive, it's because they are worried about growth.
Okay. Pranav, we'll leave it at that. Thanks so much for joining in. Jayesh, I request you to stay on for a minute because we have to take a final word from both you as well as Katrina. But just welcoming Aditi Nair in the conversation as well. Aditi, actually, we didn't ask Jayesh for his rating, neither did we ask Katrina. But Aditi, I'm going to start with you. You rating this 10, 9, 8 or slightly lower?
Look, as the chief economist of a rating agency that's regulated by the RBI, I'm not going to be able to give you a rating. Really sorry about that. But let me tell you what, this was this was a policy packed with surprises. I don't remember the last time we got so many surprises coming out of a single policy meeting. First of all, the large rate cut, the front-loaded rate cut. And with that, very interestingly, we got the change in stance. Again, cannot remember the last time that the stance changed and changed back so quickly. And then, of course, the CRR cut, which we really weren't expecting. Now, going forward, I think a couple of things are going to be really important. One, of course, how does growth respond? How does the domestic economy's resilience really come through in the next few months, before the next policy meeting, particularly? Are there any fresh cues that we have on the table? And of course, how do the inflation readings pan out? So if you would have noticed, we got the reduction in the inflation forecast for the full year, but the quarterly trend is upward. So possibly, I still feel that the Q2 number could end up being lower than what the MPC has told us even today. And if it does, that would be one of the factors that could lead to that final rate cut that a lot of us were talking about. So our view was we'll get 3 rate cuts of 25 basis points each. We've got 150 today. So that last 25, whether it will come through or not, I think is going to be very crucially determined by whether the MPC can further reduce its average forecast for FY26 inflation from the 3.7% that they've laid out today. And if they can particularly have confidence that the Q2 or Q3 number will be lower than what they forecast, then I think an August rate cut may still be on the cards, although with the change in stance to neutral, obviously the likelihood of that at this point in time is on the lower side.
Right. Aditi, stay with us. Katrina, let me come to you as well in terms of taking your closing comments. So overall, taking into consideration, you've already seen a 100 basis points rate cut that has happened in 2025. What would your expectation be, even if you have to be conservative from here on towards the rest of the year? Would it be right to say that no further rate cuts is something that you will bake in, or there is a further possibility as well?
So at this point, we don't have further rate cuts banked into our baseline forecast. Our expectation is that now that the policy rate is sitting at a neutral level, the RBI will sit back and then see how domestic conditions evolve, but also perhaps more importantly, see how global conditions evolve and then determine whether further adjustments need to be made to the policy rate and other levers as well. But at this point, I just don't think further adjustments will be needed. But it will be incredibly interesting to watch, particularly how credit growth, domestically driven credit growth, starts to pick up over the next couple of months and how aggressively banks then follow through, because that will be the key to determine how potent these monetary policy adjustments are. But I think it is certainly good news that because inflation is well contained and on the expected to remain at the lower end of the RBI's 4% midpoint, it does give them the flexibility to move if they need to. But the fact that they have changed their stance from accommodative to neutral does mean that they are signaling, look, don't expect more rate cuts unless conditions really deteriorate at this point.
Okay, Katrina, we'll leave it at that. Thank you so much for taking the time out and being with us. Really appreciate your time today, as always, by the way. Jayesh, sorry, so I know Aditi can't give a rating, as she rightly said, but is this the end of the surprises, Jayesh, for you, or do you reckon that there is ammo for some surprise? And is a surprise needed, or is a predictable policy regime actually pretty good for growth?
I think, firstly on rating, can I give 11? If
you can. You most certainly can.
No, I think you know, you look at it slightly, you know, back of the mind. It is a very thoughtful, decisive policy. Of course, as you said, like, you know, everybody was expecting cut now in August. So I think that they've done it upfront. Now, after that, naturally, you have to see the, you know, whether you are, as Aditi said, like whether you remain at 3.7 or you move to 3.9 or you go to 3.6. Even if it remains 3.7, maybe can still give you some room for rate cut. So that's something, or maybe if not August, maybe the policy after that, right? So something on that lines very clearly. On CRR also is a very, very, very decisive move. You know, one of the things I'm just trying to recollect because I haven't got time to read it, but I didn't say that it's a temporary CRR cut, right? It's a cut. So from that perspective, I think it's also getting prepared, like you are going to move to LCR guidelines. Why do have two situation? Like banks have always been complaining, we have LCR, we have CRR, why do we need both of that? So I think from that particular situation, you know, you have SLR, LCR, CRR all put together, and that is kind of putting burden on bank balance sheet also because it's zero cost. Whereas at the same time, you have, you know, RBI anyway borrowing at 0.25% lower than the repo rate. So that's something, you know, you can always keep a buffer. So from that perspective, I think it's taken a very, very decisive decision rather than going on to debate or should we reduce CRR or not, or, you know, or could this be a trend? I don't know. One has to really look at it. Could it be a trend to actually reduce CRR on a macro, on an overall basis? So I think that's the thing. It's too premature to say that, but it's something I want to look at.
So Jayesh, I'll interrupt over here. We're running slightly out of time. A quick range that you could give us, because the yields have hit the lowest level today since September 2021. What is that range you're baking in from here on, taking into consideration how the bond yields will move?
So we had 5.5% liquidity being abandoned. There is no reason why it should not be below 6, maybe whether it's 580, 590, but that's the number I would look at. Of course, right now there has been some huge demand on the short end. The long end was suffering. So if you look at the short end 5 years, anyway at 575, right? 4 year, 5 year. So there is no reason for 10 year to be at 620 or so. And I think there is enough room. But of course, there will be some profit booking coming in, as I said. And that may be another give a month or so. It will slowly trend downwards.
We'll leave it at that. Thank you so much, as always, for taking the time out and being with us on the policy day. Aditi, we won't push you for ratings, but what's the surprise element? Aditi, in a minute, if you can tell us, we need to slip into a break, but final words in a minute. What is the surprise element left for the next policy?
Very little, I think. Honestly speaking, the stance has been used so strongly to signal what's coming that I think there is probably not going to be too much surprise from here on out. And on second thoughts, with the CRR having been cut today, maybe that final rate cut is really off the table unless there are significant downside surprises on growth or inflation coming from here. And on the yields, I actually don't think that 10-year is going to come below 6%. I think 50 basis points of rate cuts are already been built in. And while there has been some down movement today, it's not been very sharp despite the surprise being 50 instead of 25. So I don't think we're going to breach 6%.
Okay. We'll leave it at that, Aditi. Thanks so much for being with us. Really appreciate your time today.